Well, it's been a tough year for the ASX. It's been exposed to competition at the same time as the average daily value of trades has been steadily declining and is now half what it was in 2007. Not surprisingly, the bottom line's been hit and ASX's profit has slid 3%. I spoke to ASX chief Elmer Funke Kupper about what's happening to the market, including his concerns about the impact of high-frequency trading and the so-called dark pools, which are the trading platforms being set up by investment banks themselves. Well, Elmer Funke Kupper, how much of your revenue comes from high-frequency trading?
Well, Alan, it's actually relatively hard to estimate that. What we do know is that for the entire Australian market, it's probably between 15 and 25%. So you should assume that flows through the main market as well and gets to us.
Well, your trading revenue is about $36 million, so that means that it's somewhere between $5 and $9 million per year.
Well, if you do straight math like that, and that will be the number. I can't confirm because we actually don't know what that number is exactly.
Well, fair enough, but if that's right, it's only about 1 to 1.5% of your overall revenue. So it surprises me that you're complaining about it when it's such a small part of your revenue. Why do you allow it at all?
Well, let's just take one step back. What we are particularly concerned about is the ongoing fragmentation of the market away from the market that everybody relies on to trade, which is the ASX, something we call the lit market. So we're concerned about dark pools and dark execution, and that today is running at an average of about 25%. In the first half of this calendar year, it's been as high as 43%. So that's a more meaningful number and a more meaningful concern. We have some issues with high-frequency trading as well, and we've made the point that we need to make sure that the economics of those businesses are more closely aligned with the market so that you don't get behaviors that damage the quality of the market. And we believe that can be done.
But the dark pools, which is the trading that's done away from the exchange in investment bank offices, is partly driven, if not largely driven, by people trying to get away from high-frequency trading.
Well, that's a misconception. I think there is a relationship between high-frequency trading and dark execution, particularly when it comes to fund managers who prefer to go dark so that they don't run into high-frequency traders. But we need to separate those two. So we've seen significant growth in dark execution for some time now, even before high-frequency trading started to grow. And so we're quite clearly separating those. At the end of the day, if we take liquidity away from the one marketplace that everybody relies on to trade and that everybody has access to on the same terms, then we are over time going to do damage to our market. That's separate from having to deal with a new form of electronic trading that has emerged overseas and is now emerging here. We have to deal with it as well, but we shouldn't confuse the two.
Now, overall trading volumes are down, obviously. You're saying that they're about $3.5 billion a day, which is about half what it was before the crisis. To what extent do you think that this is structural, that there's a sort of a permanent decline in interest in trading in equities, and to what extent is it cyclical?
Well, it's very hard to forecast consumer behavior. The decline that we've seen over the last 12 months, and again in July, is largely driven by retail investors abandoning the market. I think that's a sign of the time. The savings ratio is up. The money goes into term deposits in banks. That's not a bad thing for the economy, by the way, because banks need to be funded so they can fund the economy. So I'm not particularly worried about that. My sense is that it is cyclical. But of course, we're in a slightly unusual cycle here. And the real question is, how long does the down part of the cycle in investment run for? And that depends very much on how consumers feel about Australia, feel about their own balance sheet, and feel about the rest of the world. And the rest of the world is still struggling, and I think that will continue for some time.
The merger proposal with Singapore was obviously knocked back by the government, but I wonder if it's dead now, or are you still talking to the government about it?
Well, that specific proposal is dead, obviously, because it was dead at the time and it's still dead. Well, our conversations with the government are more about the position of our financial markets in the world and how we connect Australia better, particularly to Asia. That's firstly around regulation, so we should look north more than we look at Europe and America right now, and we're not doing that sufficiently. And we should make real decisions around our position in the world. I mean, today we are not a financial center. It's hard to become one. And we need to ask questions about whether we can become one, whether we should work with other financial centers to strengthen our position. We're active participants in that debate, but we have no particular plans to deal with another exchange right now.
But do you think that a merger between the ASX and another exchange, whether it's Singapore or something else, is inevitable?
Well, we're on the record, Ellen, as saying that exchange consolidation will continue. As an industry, we've been unsuccessful, whether it's Singapore, Australia, New York, Frankfurt, London, Toronto. They've all failed for various reasons. But of course, the economics of exchanges around attracting liquidity, providing scale, investment in technology, are still in favor of exchanges getting together. So my guess is that it will continue. It's just that the industry hasn't figured out how to actually get one done. And we can't just watch this from afar as an island. We have to decide as a country whether we should participate in that. We have no specific plans, but we're watching it.
No, but specifically, do you think that it's inevitable that the ASX will merge eventually with another exchange?
I don't think it's inevitable, and you can't build a strategy of a company around something that's highly uncertain. So our focus is on getting the regulations right, running the company well, investing in new initiatives that give us new growth, and when the time is right, these other questions will come up, but it's really not for now.
Thanks very much for joining us.
Welcome.